I'm joined here today by Peter Westmeyer, Managing Director of MB Real Estate, Billy Butcher, Director of Real Estate at KKR, and Jason Fox, Head of Global Investments at WP Carey. Gentlemen, thank you so much for joining me here today.
Welcome. Thank you.
If there's one conversation that's dominating commercial real estate discussions at the minute, it's that of rising valuations and the impact it's having on investment strategies and property types. We're here today to look at the impact of rising valuations from a slightly different angle, and that's really looking at how companies are starting to unlock the value within their real estate holdings. Now, whether that's through sale-leasebacks, REIT transactions, REIT conversions, IPOs, or the splitting of operating companies and property assets, I'd love to get a sense from you all as to really what's happening on the ground. Jason, let me open this up to you. What are you sensing? What's really happening?
Sale-leasebacks have become much more active at this point in time. When you're in a low interest rate environment, companies are taking opportunities to lock in these low interest rates, which translates to cap rates, obviously, for long periods of time. So we're seeing activity in the sale-leasebacks, whether it's public companies going through management buyouts and when they're taking private, and the sale-leaseback is a component of that financing. We're also seeing companies utilize build-to-suits, which is really a form of sale-leaseback financing where they can use a developer and a capital partner like WP Carey to finance the expansion or new development of new real estate facilities.
Have you seen a real evolution in how companies and corporates are actually unlocking and monetizing, the value that's really locked up in their real estate?
I think they're being much more progressive, and some of this is due to the activist investors out in the community right now, where they're pushing companies to really evaluate what is their core business and what is an ancillary business, where the real estate in many cases is that ancillary business. So we are seeing a bit of a shift right now where companies, whether they want to or not, are being forced to look at the real estate, and it's the right move. I mean, the investors in a manufacturing company are not looking for real estate type returns. They want to have yields commensurate with the operating business as opposed to the real estate.
Now, Billy, you're in KKR's real estate group, but you obviously started your career on the private equity side. Are we seeing this trend of corporates really trying to unlock illiquid assets and turn it into a liquidity option?
Selectively, yes. Couple of guiding themes, I guess I'd say. One is you need a source of use of proceeds, rather. So a transaction, especially corporate M&A transaction, is a great catalyst for that unlocking. But in a steady state, the question often comes, well, what am I going to do with the proceeds? Repay debt. I can borrow at 4% fixed today. Why would I do that? Obviously, share repurchases are always available, but as we know, that requires a high bar. Typically, there is a natural aversion from the typical corporate public management team to go out and repurchase shares. So that is one big theme, is what is the use of proceeds. For the opportunistic capital allocator CEO, it is a great time to pursue sale-leasebacks real estate. You have historically low cap rates, and unlike a debt financing, obviously this is a permanent sale. Sometimes there's a purchase option on the back end, but you're able to take advantage if you believe there are rising rates. If you believe that cost of capital might be higher a couple of years from now, this is a chance to actually capitalize on what are historically low interest rates and low cap rates.
Are we seeing this in specific property types? I bring this up, and Peter, you're obviously a specialist in the healthcare sector, and that seems to be, I've certainly seen a lot of headlines on that. Billy, are you seeing it in terms of specific property types?
We've done a fair amount in healthcare as well, and certainly in healthcare you see that it's quite frequent. KKR's business, in addition to being a private equity firm itself, is an agent, provides advice to other sponsors who are looking to take private companies, and also provides debt financing to them. So one of the sources we tap for deal flow on the real estate side is that third-party capital markets business. They're oftentimes offering debt financing solutions, and often then will also pepper in an offering of real estate sale-leaseback.
And Peter, give me, what are you seeing on the ground, in healthcare?
Absolutely. So healthcare is obviously going through a lot of changes, and it's a challenging time for these health systems to maintain their margins. So they are increasingly unlocking some of their value to go and use the capital as working capital. Kind of what Billy was saying, they need to have a plan now. So oftentimes they use it for physician recruitment and retention, to grow market share, and there's a lot of costs. Healthcare is a very expensive industry. So they have a capital plan, and sometimes the best use of the best access to capital is selling their real estate.
I know one of the things that I'd love to just explore is kind of the structures that are actually open to kind of corporates today. In healthcare, I've certainly read about REIT conversions. What are you seeing predominantly on the healthcare side?
Ventas just announced a purchase, a sale leaseback, where they're buying Arden Health System. They're buying the real estate, spinning it off into a REIT, and then taking a portion of the operations. They're taking a 9.9% stake in the operations. So that's a great example of something that we saw it today.
And what kind of structures are you seeing out in the market? Is it, I mean, Jason, sale leasebacks, is that kind of declining slightly? Are you seeing like the REIT conversions or kind of that splitting of the operating company and the property?
Yeah, as a percentage of our business, I would say sale leasebacks have declined some, and a lot of it is what Billy mentioned earlier. You're competing against other costs of capital, and when the debt markets are as frothy as they are now, that might be a better solution for a CFO. You can argue long-term is it, because there are repayment options on those loans. A lot of them are floating rate. There could be amortization as well, where the sale leaseback is a more permanent, piece for the capital structure. But with sale leasebacks, they're still happening. It's just in the right situations for the right company.
Clearly, the question of can you unlock whole company value through a PropCo-OpCo has become very in vogue. And as you mentioned, a number of the activists are pushing for that. Some of those make a lot of sense. In others, I would say it is a very difficult proposition to assess outside in. So from public information, understanding the tax specifics, understanding some of the contractual limitations that a company might have, very hard for a public hedge fund investor to assess whether that's possible, and yet you still see a lot of pressure from activists to really push even when that may or may not be possible.
You mentioned a very interesting phrase, kind of the PropCo-OpCo, and actually looking at this from a real estate investor's perspective, actually trying to get to the real estate assets through the operating company. How has KKR, enacted this strategy?
Well, there's one company that we participated in the take private of in 2012 and 13 called Sunrise Senior Living, assisted living, an Alzheimer's independent living operator. And they owned a good portion of their own real estate. We're a publicly traded company on the New York Stock Exchange. Their stock was trading in the mid-single digits, and we first got involved recognizing there probably was more real estate value there than the public markets appreciated. Over time, it became apparent in their sale process that some of the publicly traded healthcare REITs were ideal buyers for that real estate. And ultimately, the company traded for a take-private price in the mid-teens instead of the mid-single digits from a price per share perspective. We partnered with Healthcare REIT on that transaction. Healthcare REIT bought the real estate. We ended up buying the operator as well as some of the development properties and the development operation, and recognized the strategic value of that operator as an OpCo. And that's a case where we would play, frankly, on either side. We looked at it at first because of the real estate value, ultimately decided to be the OpCo buyer because that was what was available at a price that we thought was interesting for our capital.
Peter, are you actually, especially in healthcare, are you seeing real estate investors actually look at things a little less traditionally? Actually looking at kind of some of the operating companies and some of the healthcare companies in order to get access to the real estate? To
go back to the first part of your question, that are people getting more creative? Yeah. There's a huge capital infusion in the healthcare space. It's a huge part of our economy. A lot of people like the fundamentals and what we've got in front of us in the sector. So people are getting more, institutional investors are getting more outside the box on what they will buy. A couple years ago, people wouldn't buy long-term acute care facilities nearly as frequently as they are now. At one point it was just medical office buildings. Now people are more apt to go after the LTACs, the hospitals, et cetera. So they're broadening the scope of actual properties within the sector. Obviously there's, it's cradle to grave kind of sector. It touches everything throughout your lifespan. So people are expanding outside what was the original intent of their investment parameter.
And Jason, is WP Carey also getting more creative in terms of how they're actually looking and sourcing at deals?
Well, you have to, and we're doing it in different ways. We've been known as a net lease investor, and we've been doing it for 40 years at this point in time, but we also have a pretty big hotel presence. So we have a $1 billion hotel fund right now. We also have a very large self-storage presence. I think we're the seventh largest self-storage owner in the country right now. So we're kind of seeing, what our investors want and where we can find property types that replicate the kind of cash flows that net lease will offer. We're also expanding more globally. From our point of view, the U.S. in particular has had a lot of capital inflows, and it's difficult to find good opportunities that are off market. So having a global presence, we're able to go where we think the best return opportunities are. And over the past 18 months, Europe has been a big place for new deals for us.
Given where we are with deal flow, obviously rising valuations, one of the things that I'd love to get a sense of is, why are corporations looking to unlock the real estate value now?
I mean, valuation is certainly playing a role here. When you have the fundamentals in a lot of markets in the U.S. for real estate are pretty strong right now. Rents have increased. Occupancies are very strong, and obviously cap rates are near or at record lows at this point in time. So from an absolute valuation or proceeds standpoint, this is a pretty optimal time to be considering sale-leasebacks and unlocking real estate value.
Is it also a move to be asset light? I mean, you mentioned obviously hospitality. That's definitely a theme that we've seen run through hospitality. Is there an asset light theme running through kind of corporations' minds, Billy?
In the case of Sunrise, for example, that was our whole thesis around that business, was you actually could create what didn't exist in the healthcare space, which was an asset-light operator that was based on management contract revenue as opposed to on leasehold profits, right? And big distinction there, because one obviously is a percentage of revenue, and the other, which is what you see in the hospitality case, right? Classic example is Marriott having sold but managed back under typically 30-year plus contracts. Very stable, annuity-like business model, and they can continue to redeploy and grow as a brand. On the other hand, the idea of being an asset-light leasehold business, there are some examples of pitfalls through the last cycle that you saw of in the healthcare space or otherwise, companies selling all of their real estate, creating very thin lease coverage, and then that being a problem as profit turns down. So I think that is the lesson learned that a lot of people point to describe why they don't want to separate.
Do we see this as a trend running forward, this separating the real estate away from the operating companies?
I see it as a reluctant trend. I think that the health systems, again, I'm focused only on healthcare, so I'll talk about the health systems that we're in front of. I think that it's going to be a reluctant trend. I think health systems are going to, and as Jason talked about earlier, there's access to capital. You can go to the debt market, tax-exempt bonds, and get a very, very attractive rate. Certainly less than the cap rates that we're looking to buy at. I think that systems will continue to have to do this as they want to grow, and there's a lot of need for capital, as I mentioned earlier. There's a lot of need for capital, so they will have to do this to stay competitive, grow market share, continue to recruit the best physicians that, at the end of the day are the drivers of their revenue.
I think it's going to be all dependent on the relative value of capital markets and the opportunities for corporates to redeploy that capital. So obviously what you've seen in the last few years is very low interest rates. It has not been a period of great investment, with certain exceptions, right? Obviously the health systems is a great example where that's not true, but across U.S. business that has been largely the case. One thing I'd note in terms of in today's market where we see the best opportunity for these sale-leasebacks is really in the corporate headquarters space. So there is this question of, do you want to ever sell what is considered the most strategic real estate in your company? So one of the things that we're in the process of trying to create from a platform standpoint today is we've partnered with a group in San Francisco called Drawbridge Realty that focuses on corporate headquarters, so single tenant office with shorter lease terms. So typically 10 years or less of lease term initially, and focusing on a building that today is single tenant but could be released pretty easily and is interchangeable. And from the corporate's perspective, it's easier to sell your headquarters with the expectation that you can continue to lease it, but if you choose to relocate, that's a building that you can part with and it's not as strategic to you.
And Jason, your expectations?
Each individual situation needs to make sense on its own from a financial standpoint, but the trend that we've seen is the hurdle has always been a philosophical or a cultural issue about, as Billy said, do we feel like we need to control, and to control we need to own the real estate? The U.S., we think we've seen that evolve, and I think people are comfortable. Europe is really where we've really seen some momentum over the last couple of years, where it was a much more hesitant environment to do sale-leasebacks, and I think it's opened up quite a bit for us. I mean, we recently just did a large transaction with the state of Andalusia, and government real estate is something you don't see trade that often, and that was an opportunistic play for us where Spain has had difficulties accessing capital markets given where bonds have traded. And so we are seeing the cultural shifts over there as well, which is creating a big opportunity for us.
I would agree with Jason on Europe. That's been an area where there has been an obvious use of proceeds, recapitalizing balance sheets of corporates, and we've had some success. And one deal in particular acquired buildings that are currently being used by a telco for technical purpose, but they tend to be in infill locations, have some lease term. From the telco's perspective, it's natural to want some lease term there to continue to use these assets, but over time, as technology evolves, they may become less strategic, and so they have a natural glide path out if they choose, and yet at the same time, from a real estate perspective, we see great adaptive reuse given some of these locations, either for residential development or alternative uses. And so that'd be a classic example, and there isn't a defined use of proceeds where deleveraging balance sheets is still in vogue.